Hello, everybody, and welcome to session 2 of 3 with Peter Brandt. It's Robert Grego, Vice President of Operations here at Trade Navigator. And welcome again to 2 of 3. Peter really doesn't need any more introduction. His 40 years of successful trading for his own account in futures and Forex really speaks for itself. So, Peter, take it away.
Yeah, thanks, Rob. Can you hear me, Rob? We had a little bit of technical trouble last week. I want to make sure that we're good this week.
Yeah, you sound real good, nice and clear.
Good, good. I'm glad to hear it. Well, welcome all. Thanks for putting up with me for hopefully what shouldn't be more than 20 minutes or so. As I mentioned, this is probably going to be shorter than my last webinar, which was webinar number 1. It's a 3-part webinar. Last time we talked about why 80% of novice speculators are looking for answers in all the wrong places, and we kind of focused on the answers not to be found in trade identification, but the real answers are to be found in risk management and issues that are within ourselves, and we tried to put that in the proper perspective. So we're in session 2, and we're really going to talk about classical charting principles, and I'll touch here on the end as to how I use Trade Navigator to execute my trading program, and that kind of really ties into classical charting principles. Again, my focus here is classical charting principles, and I want to keep hitting back on that. There are a lot of people who successfully trade the market with charts and not necessarily with classical charting principles. They may use Fibonacci, they may use Gann, they may use a whole number of other things, and they do so successfully. And I'm not making comments on that approach with the use of charts. If people can make money using charts with some other thing other than classical charting, all the more power to them. And so I want to really speak directly to classical charting principles. What are classical charting principles? Well, they're really the chart patterns that we all hear about, the head and shoulders, the double bottoms, the triangles, and so forth. And those are the things we're really looking at: patterns, formations, configurations. I use all 3 terms interchangeably when I write about the markets. They all mean the same thing to me. It's basically geometric patterns that take place on a price chart. Classical charting principles really were formalized in the 1920s by Richard W. Schabacker. You can actually trace them back a little bit further than that. Charles Dow actually started getting into the whole idea of geometry, but it was really picked up by Richard W. Schabacker, who at the time was the editor of Fortune magazine, and he wrote the book Technical Analysis and Stock Market Profits. If you're interested in charting, and there's only one book to buy, and that's Technical Analysis and Stock Market Profits. It is really the real Bible of classical charting principles. I just want to make the point here that when we deal with classical charting, there's a right and there's a wrong way. I cannot tell you how many times in a day I see somebody post a chart and they attempt to be labeling it based on classical charting principles, and it doesn't even come close. That there's great abuse that is taken by some individuals when they attempt to mark up a chart and actually then define it by a geometric term. A chart pattern cannot be what somebody decides it is going to be to themselves. Chart patterns must comply with fairly precise guidelines and standards. And you have to go back to Richard Schabacker, who really does a very good job at laying out what these guidelines and standards are that a chart pattern must comply with to be a chart pattern. And in any given time frame, markets tend to either be in a sustained trend or in a congestion area where prices advance, they decline, they go up, they go down, they go up, they go down. But then you see after the fact they really haven't gone anywhere. They've remained in a trading area or a trading zone. And this trending versus congesting dilemma can really take place in any time zone. You can find it on monthly charts, on weekly charts, on daily charts, on intraday charts, and you can find in some cases that they're not all the same. You can see on a daily chart that a market may be trending. But on an hourly chart, you may find that it's a market in a trading range. And so I just want to make sure that I make the point here that this trending versus congesting really is relative to different time frames. The time frames I use are daily and weekly. And so when I think about time frames, I'm not thinking about 60-minute charts, 5-minute charts, 15-minute charts. Those don't come into the equation as for me as a position trader. During some, and I want to emphasize the word some, periods of congestions, prices plotted on a graph can form a number of recognizable geometric configurations, and I'll touch on the word some later. I'll try to open that up and unpack that a little bit. In the vast, overwhelming cases, a given market will defy understanding from the standpoint of classical charting principles. When I look at somebody who is attempting to be a classical chartist, and I see 50 different lines and all kinds of different letters and identifiers, what it tells me is that individual is attempting to come to terms with that market. They're studying that market, expecting that that market must speak to them. And in reality, for the most part, classical charting cannot define what a market's doing. It is the exception, actually, that you can look at a market and understand it based on classical charting principles. I make this claim not only at classical charting principles, but on any form of understanding the markets, whether it's Elliott wave or Gann or whatever it is. The reality is that we may try to understand the market given the tools that we have, but more often than not, the markets will define understanding or reason based on how we're trying to understand the market. Periodically, prices will form clearly identifiable geometric patterns. And depending on the correct identification of a geometric configuration, the direction and magnitude of an ensuing trend can be ascertained with some degree of confidence. And I want to point out, this is an exception where you can look at a market and you can say, I know what pattern it is, I can have confidence in the pattern, and that confidence in that pattern will work itself out based on my ability to correctly ascertain the direction and magnitude of the trend. Oftentimes a market will form a pattern that you really believe is a certain pattern, and I'll have some examples for you, but the reality is that they really weren't. As time goes on, you find out that's not what they were. True patterns that are truly identified and are correctly identified will do what they are supposed to do. But more often than not, the geometry of a pattern or geometry of a chart is misinterpreted. I want to talk about some big surprises, and some of these may find some disagreement out there with you, and if so, that's fine. At any given time, the vast majority of stocks, futures, or forex pairs cannot be understood based on classical charting principles. Again, I touched on this already. But you can't sit and study a chart. And if you just study it hard enough, whatever your stick is, whether it's Elliott wave, classical charting, Gann, whatever it is, if you just study it hard enough, you can figure out what a market's doing. I disagree with that. I think that that's false. I think in the vast overwhelming majority of cases, you can't figure it out. You can sit and study it and draw lines until you're blue in the face. But the reality is the market may not comply with the tools that you're looking at to try to understand the market. As a general rule, charts are only useful for showing where a stock, futures, contract, or forex have been. I actually do not believe that charts are useful to predict prices of any given item. I think the critics are right. I think charts don't work. Charts cannot predict prices. And keep in mind, I'm making that statement as somebody who has used charts to make a living in the markets for 40 years, but I still contend that this statement is correct. The critics are right, charts don't work. Charts cannot predict prices. There's a usefulness to charts, and I hope to touch upon what that is. And again, coming back to it, intently studying any given chart at any given time until the chart gives up its secrets is a waste of time. There are benefits of charts for trading, and I'll touch on what I view they are, at least from my standpoint. Why do I chart? Why do I keep charts? Why do I look at charts? Periodically, large, sophisticated trading operations, and they may be in different parts of the world. More often than not, they are acting without knowledge of each other. They don't even know of each other. Uh, they may know the firm, but they don't know they're doing the same thing in the market. But these sophisticated trading operations will recognize that a given market is significantly mispriced relative to the present or future economic conditions, that basically the price of a market is wrong. I'm not a believer, of course, in random walk. I traded at the Board of Trade. We're just on the street. We had the University of Chicago, which basically believed that all pertinent facts were priced into the market at all times. And of course, people at the Board of Trade and the Mercantile Exchange greatly disagreed with this fact. We felt we made a living because oftentimes the markets were wrong. But there are periodically times when big operations recognize that the market is mispriced, that these trading operations will engineer a significant price advance or decline. It may take them months, sometimes many months, to engineer and prepare a market for a move. That the trading activity of these operations leaves certain telltale signs, taking the form of concise geometric patterns. These engineered moves are very uncommon. Having gone through this list of 4 things, don't start paging through your charts looking to try to find an engineered move on every chart page. These only happen maybe 10 to 20, maybe 30 times a year in all futures and Forex pairs combined. Talk about the benefits of classical charting principles for trading. Well-constructed classical chart patterns provide possibilities, and many of you who follow me know that you'll hear me talk about possibilities. I look for possibilities. I don't look for probabilities. I definitely don't look for certainties. I think the best that we can find are possibilities. We construct our trades and our ideas about market activity based on possibilities. Chart patterns, by their very nature, lend themselves well to predetermined and measured trade risk. This is, I think, the biggest benefit of charts, in my opinion, is charts can give you some natural points in the process of construction where you can say to yourself, if the markets go here, I'm wrong, based on what I'm assuming the market's going to do. All a trader can expect in his or her trading approach is an edge or a niche. That's it. Sometimes the niches aren't very big. Sometimes the edges aren't very big. But it's all that we really have as traders is an edge or a niche, and we have to exploit those. The possibility of a meaningful move combined with the ability to manage risk provides a trader with an edge. That's really, in my opinion, the real value of charting principles. Is we find the possibility of moves, and we combine that with the ability to do real engineered and aggressive risk management. And that, for me, is where charts pay off. I want to talk about some of the things that I see that just kind of make me cringe. This is a chart of Johnson & Johnson where somebody put this up and called this a head and shoulders. Left shoulder, right shoulder, left shoulder, head, right shoulder. Based on the correct principles of classical charting, this is not a head and shoulders. This does not comply to the requirements of head and shoulders pattern. And I look through a number of social bulletin boards during the course of the day just to kind of get a feel for what people are thinking. And oftentimes, I'm amazed at the abuse traders do to true classical charting principles. Here's a couple of examples. The top one, there's a dashed trend line. I would never draw that trend line on the chart. That trend line does not exist based on true classical charting principles. The charts below, I don't know what those are. They probably comply to some some school of charting that I'm not aware of, but they're definitely do not comply with anything that could be termed classical charting principles or this, although I do see, I think, what some people call Bollinger Bands. But if you look at this chart, there are lines drawn everywhere. That many lines in the chart immediately tells me that somebody is not looking at a chart and understanding it from the standpoint of classical charting principles. Here's I take shot at people who I think make abusive, fraudulent claims, and here's one that I just saw today. Give me 3 days and I'll show you how to read the charts with 90% accuracy. I can show you charts with 90% inaccuracy. So I don't know how you can be 90% accurate with charts. That to me just defies reason and everything that I've learned about charting, quite frankly. I want to go through the factor of self-imposed rules for trading with classical charting principles. These are kind of the rules as we approach markets in terms of our own trading. What rules do we have? What rules do we impose upon ourselves related to classical charting principles in our physical trading operation? And I want to touch on those. All chart analysis begins with weekly charts. This is our rule. It doesn't have to be yours, but it's my rule. If a weekly chart does not show a pattern, there's no sense in looking at a daily graph or no sense in looking certainly at any intraday graph. I start with weekly charts, and I'll touch on this toward the end of this presentation as to how we do that. But weekly charts are our starting point. I want to be able to see a chart pattern in a weekly chart. Now, it just so happens and I don't know why, that generally speaking, if a chart pattern is not at least 10, 12, 14 weeks in duration on a daily chart pattern, it normally then will not show up on a weekly chart pattern as something that I can recognize. If I draw more than 4 lines on a 12-month daily chart of a futures, stock, or Forex cross, chances are I've drawn too many lines. I get comments all the time about my markings and charts being oversimplified. I take that as a great compliment. The most reliable chart patterns tend to be those that require more than 12 weeks to form. I want to see a market, I want to see a chart pattern that's 12 weeks to form. Then all of a sudden I have a chart that I can build a trade around. I want to be aware of chart patterns that I call diagonal nature. Now, those folks of you that are there that I communicate with on a pretty regular basis understand what I mean by diagonal. I'm talking about a line that's kind of diagonal on the chart. It's angled on the chart. Beware of chart patterns that have boundaries. I want chart patterns that have horizontal boundaries, or at least chart patterns that break out through a horizontal boundary. Now, examples of diagonal chart patterns would include symmetrical triangles. It would include trend lines. I don't use trend lines. Now I know some traders who make money trading trend lines, and so I want to give them I want to give them the nod and say congratulations, you can do it. But in my own way of thinking, you give a chart book, a ruler, and a pencil to an ape, and you come back a day later, he's probably going to have driven some line that makes sense. A wedge, falling wedge, rising wedge, these are diagonal patterns. Beware of diagonal patterns. And then finally, a pattern is not a pattern until it's completed. And even then it can fail. Oftentimes I'll talk about patterns, and usually I'll talk about possible patterns. There's a possible head and shoulders. There's a possible rectangle. And there's a possible this or that. And that doesn't mean that I believe that there is a head and shoulders. There is a head and shoulders pattern, and it's really not a head and shoulders pattern until it's completed. And even then it can fail. Schabacher identified 5 types of patterns which occur at price reversals. Now, I'm going kind of to the textbook here, but I want to identify the 5 patterns that Schabacher says these are patterns where we can have market reversals. The rest of the patterns are continuation patterns and at times can be reversal patterns, but those are the gross exceptions. The head and shoulders pattern. head and shoulders, if drawn correctly, if analyzed correctly, if understood correctly, is the most reliable pattern of all classical chart patterns. The common or rounding turn, and I'll show you examples of all of these here in a minute. The triangles, which we have the symmetrical triangle, and never warned you against that, but nevertheless, Schabacher identified it as a pattern which can be a reversal pattern. Right angle triangle, that's a descending triangle or an ascending triangle, double tops or bottoms, and the complex pattern. All of these patterns must comply with certain rules. And then, of course, Schabacher also identifies a whole number of minor patterns. The horn, M-tops, W-bottoms, compound fulcrums, all the way on. The last one on the right-hand side, the cup and handle, I have accepted that. Even though Schabacher never alluded to a pattern called a cup and handle, I have been convinced that that's a good pattern, and I put it into my repertoire of patterns that I'll identify. But you can kind of take a look at the rest of them. General rules that I follow is the more isolated a pattern is vertically, the greater its reliability. I'll show you an example of that with the wheat market currently. Patterns need to be isolated vertically. The vast overwhelming of chart patterns will fail. Patterns on intraday graphs are even more susceptible to failure. I know people are day traders. I know people look at patterns. I know there are some patterns that work on as day traders, and I give you credit to if you can make patterns work for you and make money as patterns as a day trader, all the more power to you. Patterns on weekly charts I find are the most reliable, and horizontal patterns are far more reliable than diagonal patterns. Now, there's some reason for that. I'm not going to go into that in this webinar, but there's some specific reasons why that's true. Okay, I want to kind of now go through how Factor uses Trade Navigator. What we do is we go through and review the weekly charts of what we call the long list, and I'll show you that in a minute. From the long list, we create what we call the short list of 20 to 30 markets that on the weekly chart have grabbed our attention. They've stood out. There's something about the chart that we look at. Now, I go through a lot of charts, and I'll show you that. I'll spend about 1, maybe 2 seconds on a chart. If there isn't something that has grabbed me on a chart within 1 or 2 seconds, it's not a chart that I'm going to spend any more time from that. Then we go to the daily charts. We'll look at the daily charts of the short list, and from that we create what we call our active list. Now, that also includes any charts that represent markets that we are in. Okay, now we'll focus here. This is Trade Navigator, and we'll focus here on this. You can see here that I have a long list of markets, and this goes from the indexes. I look at all of the major indexes, the U.S. as well as elsewhere. I look at all of the major currency crosses. I have some stocks on here. Usually I have 10, 15, 20 stocks that'll be on here. Then I'll look at the futures market. And when I look at futures market, I'll look at them in a couple different ways. I mean, here I'll look at crude oil, but I'll look at it as a continuation chart. And there are different ways to draw continuation charts. And I'll look at them that way. Then I'll look at individual contract months. And so, in my opinion, when I look at crude, I may look at 3 or 4 different charts, but I'm really looking at crude. It's crude that I'm looking at. And so this is our long list. And from the long list, we'll go through the weekly charts of our long list every week. And from that, we create a short list. From a short list, we'll go to an active list. Now, I just want to show you some examples of the chart patterns that I talked about, that I mentioned as chart patterns that Schabacher listed. This is an ascending triangle. This is the dollar Chinese yuan cross. This is a weekly chart, but you can see it's an ascending triangle. This is the dollar yen. Here's a symmetrical triangle. This one worked. A lot of times symmetrical triangles don't work, but I'm just showing you examples on the chart of these patterns. This is the US dollar Singapore dollar cross. This is, again, a symmetrical triangle. This is Amazon. Now, this could be even identified as either a cup and handle pattern or a right angle triangle. I have this wrong up here as symmetrical triangle. It would be a right angle triangle and ascending triangle or cup and handle. Here's crude oil. This is a weekly chart and shows the massive symmetrical triangle top that developed in crude oil that broke out late in 2014 and has resulted in cheap gas. I paid $1.57 at the pump the other day. I don't think prices are there anymore. Here's cotton. This is what's probably called a common turn. It hasn't completed yet. You can't really identify anything specific. It's just kind of lazily rolling around, and that's common turn. Here's a head and shoulders top that occurred just recently in the S&Ps. You can see the shoulder, you can see the head, you can see the shoulder. In this case, is the complex head and shoulders top because they're not clean shoulders. They have different characteristics. Here's Australian dollar where you can see a symmetrical triangle with a rectangle at the tail end. Here's the Canadian dollar, and you can see a double top or a failure top. Here's Japanese yen. There's a head and shoulders top. This is the futures market, and here's a head and shoulders top that was completed in late 2012 that's really led to the entire trend that we've seen in the yen. This is the New Zealand dollar. It's a rectangle top. Now, I want to point out something here on this. I talked to you about markets that fail. This was a market that I had identified, and I really believe that the gold market had bottomed. That we had a 5-point symmetrical triangle reversal bottom that was completed here on October 9th, and of course this market's rolled around. Now, I then look at this and say this was not a symmetrical triangle. It failed. It was nothing. I don't know what it was. If it was a real symmetrical triangle, it would have worked. And so I have no idea what gold is all about at this point. Here's a sugar market where we can see a big symmetrical triangle top followed by a big channel, and we haven't talked about channels yet, but a big channel going down. Now I want to show you something. A lot of people have talked about this in March sugar as being a double bottom. Now, it's given an explosive move, and those of you that caught this and are on the long side, I congratulate you, but this was not a double bottom. There are criteria for double bottoms. Double bottoms have lows that are at least 4 or 5 months apart, and the height of a double bottom has to equal 20% of the value of the underlying commodity. Okay, now I'm going to take you to the active list, and this is the list that came out of our short list over this last weekend. These are markets really that Factor is looking most closely at this week. I'm going to start out with a market that we're interested in. Is kind of on our watch list, but you can see, and this is the British pound New Zealand dollar, but you can see that we had a massive head and shoulders bottom on the monthly chart. It reached its objective, but we don't think it's done. We think this cross eventually is going to go to 2.89, and so we're keeping our eye on it, and we're watching the daily chart. And we're thinking maybe this is something here. It really hasn't formed a formation we can recognize, so we're not doing anything, but it's on our watch list. I'm showing this. It's not a trade for us. It doesn't line up with the trade, but people who we communicate with have seen this chart many times. It's basically what I think is going to happen to S&Ps over the next 7-8 years. I don't think they're going anywhere. I think they're going up, they're going down, and they're going nowhere. We are following the Japanese yen, and this shows you the Japanese yen going way back. We had an ascending triangle. I think what we have here is going to be some sort of head and shoulders, whether it's a head and shoulders that completes or a head and shoulders failure. I don't know yet. Amazon, we're long Amazon, the firm at the red dot, based on a cup and handle. We're watching the cocoa market. Really, we're taking a look at the cocoa market from a longer term, and we believe that the cocoa market from a longer term is, and I'll show you the weekly chart because that shows it better, but we think, whoops, wrong market. Dollar index, this was a symmetrical triangle. We think that US dollar index still has higher to go. We're watching the market. We're actually long the US dollar index. based on the fact that we believe that what we completed here was a head and shoulders failure. We're long in here. We have tight stops. We're watching it. The market we may look at for a little bit of a scalp. This is the Euro stocks, and what we see here is a little flag pattern. We normally look for longer patterns, but we do like tight, little, concise patterns. This is the U.S. dollar. This is the Euro U.S. dollar, which we view as having completed a 7-month channel. We're short in the market, but we're watching it closely. Here's a market that we keep watching. We're not in it, but we believe that the peso had completed a big symmetrical triangle way last year. It's still going to 53 cents. We're watching it. It's kind of on our watch list. Copper building a symmetrical triangles. Right now, this is too short for us. Even if this completed, we probably would not trade this because we're looking for patterns that are 12-week in length. This hasn't quite made it, but we have it on here because we think if the market drifts sideways for a bit. Now, we're looking for an opportunity to sell the cattle market. We view this as a massive M or failure top in cattle. It has a target of 124 in the December contract, a target closer to 120 on the continuation charts. We think it's eventually going to go there. This has been a big rally. That's been a retest, and so we're watching it actually on an hourly chart. This is a case where we may look at a market based on intraday charts, and we think that we basically can form something in here. We're watching this. It's still not set up right for us. What would be set up right for us might be that the market goes back up and makes a new high, and we have an expanding or a broadening pattern. And so we're taking a look at getting involved in the cattle market, but not yet. Our biggest position right now is in the dollar Swiss franc, and that's based on symmetrical triangle. It started back in March of 2015. We like this market mainly because we think that the Swiss National Bank is attempting to devalue the Swiss franc. Now, keep in mind, when you have a cheaper Swiss franc, that means the US dollar Swiss franc will go up. You also could trade this market based on the futures market. Normally, we will trade futures if we have a futures contract. In this particular case, we chose to go with the spot market. So that's about it. I just want to thank you, just to kind of sum it up. We view the key to classical charting principles is we want to maximize the win rate in identifying classical patterns. The way we do that, look at weekly charts, ignore diagonal charts, look at horizontal charts, make sure charts are cleanly, they're clean. They're not, they're not subject to multiple interpretations. We can look at a chart and say, okay, we know what it is. We want to exploit correctly identified chart patterns to the full extent of the measured move. A lot of times people experience 8 straight losses. They finally get in a winning trade. The first thing they want to do is take profits because they're afraid to let the profits go. Actually, we want to get into trades and not look for reasons to get out, but look for reasons to stay in, at least in a portion of our trade. With aggressive risk management, we want to minimize the capital damage when a pattern is identified incorrectly, as was the case of gold. In the case of gold, what we showed you is we actually bought that symmetrical triangle, but because of aggressive risk management, we always assume that maybe we're wrong in our interpretations. So we use aggressive risk management. We walked away from the gold market without losing money. And that's the idea of aggressive risk management, is that even if you misidentify a classical chart pattern, there's a chance that at least you can minimize your loss. So thanks for hanging in there. There are some other things I wanted to cover, but we're here for 35 minutes. This is as long as really I want to take any of your time. It's quitting time. I want to thanks for your attendance, and we will talk to you again when we do the third webinar, and that'll be our final webinar. And that webinar, what I want to do is get a little bit into our risk management. Look at a market like gold. Why, even though we were wrong in our interpretation, were we able to walk away without being scarred in the gold market? Same thing in silver. We saw what we thought was a bottom in silver. We went long silver, yet we escaped without being spanked too bad. And so go through some of those things on a rudimentary basis. So again, thanks for your time. And Rob, I'll let you close this thing up.
All right, Peter, thanks. It was a fantastic webinar. Appreciate that. Thanks again, Peter.